Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intuit.
If you find our talks useful, please consider subscribe, like, and comment underneath. But before we jump into the actual numbers today, we need to quickly mention StockOracle. You'll find a special 14-day trial link right below in the description. Just a quick heads up, that is an affiliate link, so the channel may earn a commission at no extra cost to you.
Right, and it's important to remember that StockOracle is an AI-aided stock research platform. It is, absolutely not financial advice, it's not a trading signal service, and it doesn't provide real-time market data. The AI insights and valuation estimates that it gives can be incomplete or wrong, so you always need to verify important facts for yourself before making any moves.
Exactly. Always do your own homework. So getting right into today's topic, we're looking at a pretty wild scenario. I want you to imagine a company that has nearly doubled its revenue footprint in just 4 years, which is, it's massive.
Oh yeah, that scale of growth is incredibly rare.
Right. And they boast 80% profit margins, and they haven't had a single down year in recent memory. But if you look at the stock chart, it's plummeting. It looks like they are facing imminent bankruptcy.
It really does. It's the ultimate diagnostic puzzle for anyone watching the markets right now.
Yeah, today we are focusing on Intuit, the software giant behind TurboTax and QuickBooks. Our mission for this analysis is to figure out if this historically dominant platform is just a dying dinosaur facing an existential crisis, or, are we looking at a deeply undervalued, contrarian goldmine?
Because you have this massive disconnect, right? There's a huge gap between the tangible, real-world performance of the actual business and the hyper-pessimistic perception of the stock market. It's honestly a real-time case study in how fear of the future can completely override the math of the present.
Okay, let's unpack this. Because the wealth-building context here, the fundamentals we're looking at, they aren't just good, they are absolutely staggering. Let's look at the cash this business is actually generating. Intuit's revenue has exploded from $9.6 billion in fiscal 2021 to a projected $18.8 billion in fiscal 2025.
Doubling revenue at that specific scale, especially for a mature tech giant, it's almost unheard of.
And we aren't seeing any signs of that revenue engine sputtering out either. The data for the second quarter of fiscal 2026 shows total revenue rising another 17% to hit $4.7 billion just for that quarter.
And we really should highlight the profit on that, too.
Oh, absolutely. Net income, the actual money left over after all the bills are paid, that surged nearly 50% to $693 million. Their global business solutions segment, which is mostly driven by QuickBooks, that's up 18%.
Yeah, and when you dig into their profitability profile, it's phenomenal. They boast gross margins of nearly 80%, and their net margins sit around 22%.
Which means, in plain English, for every dollar they bring in, it costs them very little to actually deliver the software. They are essentially printing cash at this point.
Exactly. That financial dominance is the core of the paradox we're exploring today. You have this business that is demonstrably thriving on paper, right? Generating massive cash flow, expanding its top line quarter after quarter.
Yet, despite all of that incredible momentum, the stock is currently trading around $332. That is down over 59% from its recent high of over $813. Year-to-date returns are just a brutal negative 52.75%.
It's a massive hairpit.
It's like watching a star athlete put up absolute record-breaking Hall of Fame stats on the field, but all the fans are just abandoning the stadium in droves.
Throwing their season tickets in the trash on the way out to the parking lot.
Literally. So I have to push back here on the market's logic. If Intuit is printing this much cash, and if they're growing at double digits across their core segments, why is everyone running for the exits? What is Wall Street seeing that the balance sheet isn't showing us yet?
Well, if we connect this to the bigger picture, we have to remember that financial markets are relentlessly forward-looking.
Right.
A balance sheet really only tells you what a company did yesterday. The stock price, on the other hand, tells you what the collective market thinks the company will do tomorrow. And right now, Intuit's price-to-earnings ratio, the main metric we use to see how expensive a stock is relative to its profit, that is compressed all the way down to about 19.
Which, for a high-growth technology giant, is incredibly cheap.
Very cheap. The market is assigning that steep discount because it is pricing in a structural existential threat to the company's primary competitive advantage.
And when we talk about a structural existential threat to a software company in 2026, we all know what that means. Artificial intelligence. It's the ultimate boogeyman for software margins.
Exactly. The fear that AI is going to fundamentally disrupt the entire concept of tax filing is the primary weight dragging this stock down. For instance, there was a very influential recent downgrade from Goldman Sachs. They actually moved Intuit to a sell rating.
Wow.
Yeah, and their reasoning is purely mathematical. They noted that modern AI models can now process a standard tax return for just 12 cents in raw computing power.
Wait, 12 cents? That is staggering.
Just 12 cents. Now, contrast that 12-cent computing cost with $162 that TurboTax charges for a typical user's return. The margin difference there is astronomical.
I mean, that's not even in the same universe.
Right. So Goldman Sachs modeled this out, and they estimate that if just 20% of filers shift away from traditional software and over to these AI-driven alternatives, we were looking at an 18% structural decline in TurboTax revenue by the year 2030.
And based on the current market landscape, this is no longer just a theoretical threat debated in boardrooms, right? We have actual competitors actively emerging. Companies with names like Perplexity Tax and Chime Tax are building credible services based entirely on these hyper-cheap AI models.
Oh, absolutely. They are looking at that $162 fee and seeing a massive opportunity to undercut Intuit. And the pressure is already showing up in the data. Intuit actually admitted on their own recent earnings call that they are losing on price in the do-it-yourself segment.
Oh, really?
Yeah. Lower-income filers with very simple tax situations are starting to migrate away from TurboTax toward cheaper or entirely free alternatives. It actually got to the point where Morningstar downgraded their assessment of Intuit's economic moat, their competitive defense, from wide to narrow.
Man, it feels a bit like watching the electronic calculator replace the wooden abacus. If the technology is just fundamentally cheaper and faster, the old way of doing things becomes obsolete. But I have a highly skeptical question about this whole bear case narrative. Is a 12-cent AI tax return actually something you would trust with the Internal Revenue Service? Or is Wall Street just panicking over a shiny new toy? Because to me, the stakes of a bad tax return are vastly higher than a bad AI chat prompt.
Definitely.
Like, if a language model gives me a bad recipe, I eat a bad dinner. But if an AI hallucinates a deduction on my tax return, I get audited, fined, or investigated by the federal government.
What's fascinating here is that you've hit on the exact distinction that separates an existential threat from a manageable one. The DIY segment, meaning people with very simple, straightforward returns, like maybe a single W-2. Yes, that segment is highly vulnerable to a price war. A 12-cent AI can do a simple return perfectly.
Right, because there's no real complexity.
Exactly. But the ultimate battleground for the future of this company isn't actually software processing speed or raw computing costs. The real battleground is trust.
Because trust implies liability.
Precisely. And this transitions us perfectly into the catalysts, specifically how Intuit is actively defending its empire. Because right now, AI completely lacks liability. You cannot sue a large language model if the IRS knocks on your door asking why you claimed a business expense you didn't actually have.
So Intuit's strategy is to lean heavily into the one thing the AI simply cannot provide.
Yeah. Intuit is aggressively pivoting their business model toward a premium product tier called TurboTax Live. This is a service where credentialed human professionals, actual CPAs and tax experts, review the returns generated by the software.
Oh, I see.
And this human-assisted segment is not shrinking at all, it's booming. It is expected to grow 36% this year alone, and it's projected to make up 53% of total TurboTax revenue.
Okay, here's where it gets really interesting. Because Intuit is essentially building a hybrid vehicle here. They are taking the blazing fast 12-cent speed of an AI engine to do all the heavy lifting of data entry and processing, but they are making sure a credentialed human driver is holding the steering wheel for safety.
A human driver who can legally represent you in an audit. That is the critical feature. AI models cannot take legal responsibility for errors. When you pay for TurboTax Live, Intuit isn't just selling you software to fill out a form. They're basically selling you a regulatory shield against the government.
But wait, does bolting a human onto the process completely erase that massive margin advantage we talked about earlier? We established they have 80% gross margins. Human experts, especially credentialed CPAs, are very expensive.
They are.
So is that liability coverage the exact premium customers are willing to pay, or is Intuit going to bleed cash trying to pay all these human reviewers?
That is the multi-billion-dollar question that Wall Street is debating right now. But if we look at the financial data, Intuit is actually expanding their profit margins despite this massive shift toward human expert.
Really?
Management recently projected their standard operating income to increase by 17 to 19%. They are utilizing human experts, yes, but they are doing it at an unprecedented scale. They are leveraging their network effects across a massive ecosystem of 100 million customers. When you combine TurboTax, QuickBooks, Credit Karma, and MailChimp, they have a data advantage that allows those human experts to work incredibly efficiently.
Because the ecosystem keeps the customer locked in, and the data is just flowing seamlessly between their small business accounting and their personal taxes. It's all connected.
Exactly. And there is a massive macroeconomic tailwind coming that plays right into this human-assisted strategy. A major catalyst.
What's that?
Well, the upcoming implementation of the One Big Beautiful Bill Act.
Oh, right. The major new tax legislation that's been dominating the headlines lately.
Right. And we remain completely neutral on the politics behind it. But from a purely analytical standpoint, this legislation is expected to significantly increase tax complexity for the average citizen. It introduces new brackets, new deductions, and complex new rules.
Yeah, people are already confused by it.
Exactly. And at the same time, it potentially increases the average refund size for many filers. Historically, we have decades of data showing that whenever tax complexity goes up, consumer anxiety goes up. And when anxiety goes up, demand for assisted filing products completely surges over simple do-it-yourself options.
Because suddenly, a 12-cent AI chatbot doesn't feel quite smart enough to navigate the new legal loopholes. You want a certified human to make sure you get the absolute biggest refund possible under the new law.
The upcoming tax season is going to be the ultimate real-time test of this dynamic. Wall Street is waiting to see exactly what you just described. Will customers default to the cheaper, emerging AI alternatives to save a few bucks, or will they retreat to the premium safety of TurboTax Live when faced with a confusing new tax code?
It is a fascinating psychological battle. It's not just about the underlying math of the tax return. It's about monetizing human anxiety regarding the government.
Which brings us to how Intuit's management team is handling that anxiety, not just from their customers, but from their own investors. Because they are not sitting back passively hoping the market realizes they have a defense strategy. They're utilizing their massive corporate war chest to financially engineer a floor for the stock price.
Let's dive into that financial engineering because the sheer scale of the capital they are deploying is wild. They just authorized a massive $8 billion share repurchase program.
$8 billion. Let's put that into context.
Yeah, it represents roughly 11% of their entire market capitalization. Buying back that much of your own stock is like a poker player confidently pushing an enormous stack of chips to the center of the table, looking the skeptical Wall Street analysts dead in the eye and betting entirely on themselves.
It is the ultimate signal of corporate confidence. You do not authorize buying back 11% of your own company if you internally believe that AI is going to bankrupt your primary business model in 3 years. Furthermore, a buyback of that size fundamentally alters the supply and demand mechanics of the stock.
Right. By removing those shares from the open market, every remaining share represents a slightly larger piece of the profit pie.
Exactly. They also recently took on debt to fund this strategy, issuing $1.75 billion in senior notes. Essentially, they took out a massive corporate loan at today's interest rates, strictly to fund continued growth and to return capital to their shareholders.
Wow.
And at the same time, they made a hard, aggressive pivot on operational efficiency. They implemented a 17% workforce reduction.
That's about 3,000 employees let go.
Right. And the chief financial officer confirmed that the savings from those layoffs will not be reinvested into experimental projects, but will flow directly to the bottom line to enhance overall profitability.
So they are ruthlessly streamlining the operation. The logic is clear, I guess. Even if top-line revenue growth slows slightly because they are losing the cheap DIY customers to AI competitors, the overall profitability of the company will actually increase because they're operating so much leaner.
That's the plan.
I see the logic, but I have to point out a contradiction in the sentiment data here that caught my eye. If the stock is such a screaming bargain and the company itself is buying back $8 billion in shares, why does the SEC data show that internal executives have been net sellers over the last 90 days? Now, it's a relatively small amount, fewer than 4,000 shares sold by insiders. But why are the people inside the house trimming their personal positions while the company buys?
This raises an important point about how we interpret insider activity versus institutional action. It is entirely fair to say that insider selling can sometimes be a red flag. But context is everything. Selling fewer than 4,000 shares across a massive, highly compensated executive team is usually just routine financial housekeeping.
Makes sense.
It's executives diversifying their personal portfolios, executing scheduled stock-based compensation sales, or just generating cash to pay their own tax bills.
So it's the CEO paying for a new vacation home, not a coordinated evacuation of a sinking ship.
Exactly. You have to weigh that tiny, insignificant ripple of personal insider selling against the massive tidal wave of an $8 billion institutional buyback. The buyback serves as a structural counterweight to the pessimism.
And yet, even with that counterweight, market sentiment remains deeply, deeply polarized. It is almost like different analyst firms are looking at two completely different companies.
It is the definition of a battleground stock right now.
Yep.
There is absolutely no consensus.
We have TD Cowen downgrading their outlook. We have Goldman Sachs slapping a rare sell rating on it. But then, looking at the exact same financial data, JP Morgan and Argus maintain highly positive ratings. Jim Cramer has publicly backed the stock as a prime contrarian play. And there is a detailed valuation model from TICAR targeting $444 a share in their base case scenario, which would imply a massive 66% total return from current levels.
That extreme polarization is exactly what creates either a historic opportunity or a massive value trap, depending entirely on which side of the thesis ends up being correct.
There's also a speculative element brewing in the background. Analysts note a short squeeze watch in effect. The technicals show the stock recently experienced a sharp 5-day rally, jumping 10%. Now, the trading volume was relatively light, so it is not a confirmed breakout. But it shows that the bearish positioning against this company has become incredibly crowded. When a stock is heavily shorted, meaning investors are borrowing shares to bet against it, even a tiny bit of good news can force a rapid, violent upward spike as those short sellers scramble to buy back shares to cover their losing positions.
That dynamic creates a highly asymmetric setup. The market has already hammered the stock down roughly 60% from its highs.
Yeah.
It has seemingly priced in the absolute worst-case scenario, the idea that cheap AI will systematically destroy their business model.
Right.
By assigning a low price-to-earnings ratio of the 19, Wall Street is effectively saying, we believe Intuit is a zero-growth utility company. But Intuit's management is looking at their own books and saying, we are a high-growth technology platform, we are actively expanding our profit margins, and we have 100 million fiercely loyal customers locked into our ecosystem.
So what does this all mean for someone trying to make sense of this data? When you take the terrifying 12-cent AI threat, the legacy of the $162 TurboTax fee, the human-backed defense strategy of TurboTax Live, and the sheer financial gravity of an $8 billion poker chip buyback, where does the analysis ultimately land? What's the final verdict?
When we synthesize all of these conflicting metrics and narratives, the aggregated data gives Intuit a bullish score of 7 out of 10.
7 out of 10. That is a solid score, but it certainly acknowledges the turbulence.
Because the risk is very real. But this is viewed as an asymmetric risk-to-reward scenario. For contrarian investors, the core thesis is that the broader market has vastly overreacted to the idea of a 12-cent AI taking over the tax industry.
Yep.
Wall Street analysts got spooked by the rapidly dropping cost of raw data processing. But in their panic, they completely ignored Intuit's proactive, aggressive pivot to human-backed trust. They ignored the underlying fundamentals of a business that is quite literally printing cash. And they are severely underestimating the massive price floor that an $8 billion buyback creates in the market.
It is a bet on the complexities of human psychology just as much as it is a bet on software architecture.
It is. The analysis suggests an investment time horizon of 2 to 4 years. It is going to take several quarters for the broader market to slowly digest the reality of AI speed versus human liability. The market desperately needs to see the concrete results of the next few tax seasons to prove unequivocally that the TurboTax Live strategy can hold the line against cheaper competition.
It really is a fascinating intersection of technological fear and undeniable financial fundamentals. But as we wrap up our discussion today, I want you, the listener, to think about a concept that builds on everything we have unpacked.
Yeah, we established that artificial intelligence is getting incredibly proficient at processing tax data for 12 cents a return. Well, we have to ask ourselves, who else has access to incredible, heavily funded AI models?
The Internal Revenue Service.
The IRS.
Oh, wow. That is a terrifying thought.
It's the logical next step. As tax complexity inevitably increases over the next decade, like with the upcoming One Big Beautiful Bill Act tech, the government is absolutely going to deploy its own advanced AI models to find errors, to detect discrepancies, and to audit citizens with unprecedented speed, accuracy, and scale.
An automated army of AI auditors looking at every single receipt.
So what if Intuit's ultimate evolution isn't just remaining a software company that helps you fill out a digital form? What if their true, long-term, multi-billion-dollar value proposition is acting as a privatized AI-powered regulatory shield for the average citizen?
That is wild.
Right. If AI makes the federal government ruthlessly efficient at auditing us, perhaps a company like Intuit, with its vast ecosystem and human-backed expertise, becomes the indispensable shield that audits the government right back. It is no longer just a transaction about filing taxes. It becomes a subscription for digital self-defense.
Digital self-defense against an AI-powered IRS. Now, that is a premium product I think a lot of people would gladly pay way more than 12 cents for.
It completely changes the entire paradigm of their value proposition in the market.
It really does. And that is exactly why we look past the surface-level panic of the daily stock charts. Because understanding these opposing forces, the fear of disruption from a massive technological shift versus the cold, hard math of a company optimizing its margins and buying back its own stock, that is the true shortcut to being well-informed. You have to be able to see the complex machine behind the raw numbers, and sometimes you have to realize that the machine isn't broken at all. The market's X-ray vision is just a little blurry.
Very well said.
Well, that does it for today's analysis. If you want to dive deeper into this kind of data, remember to check out the special 14-day trial link for Stock Oracle in the description below. See what their AI-aided stock research platform can uncover for you. And if you enjoyed today's talk, please hit that subscribe button, leave a like, and comment below with your thoughts. We'll see you next time.